Matt, welcome to the show. First of all, Matt, just want to say it's an honor to have you on the show and I greatly appreciate your time today. So thank you very much for coming on today.
Oh, my pleasure. Thanks for having me on your show. I'm honored to be here.
Over the past several years, I feel like you've been a great mentor and inspiration to me.
Oh,
I feel like we've
thanks.
seen a massive, transformation, massive acceleration in your real estate journey here, right? Over the past 5 years, I've known you roughly.
Yeah. We met back in Boston. Well, Brookline, technically. Yeah.
That's right. Yeah. For our viewers back home watching this, the story is that Matt was on the same train as me. That the B line, I think, the Green Line in Brookline, Mass.
Yeah.
And
Yeah.
I overheard you talking about real estate. And I was trying to do some real estate deals at the time. Started a conversation, and then you invited me to some real estate investor groups in Newton, Mass. And we've just kept in contact ever since.
Yeah. That's the story.
And your portfolio has just taken off ever since then. It's great. So it looks like you've now managed or owned over 10,000 apartments. Is that right?
That's correct. I would say not owned to be specific. I've
Okay.
invested in over
That's it.
10,000 units. And so the distinction I want to make with that is
Yeah.
that 7,000 of those units are deals that I have just invested in as a limited partner. But I have just about 4,000. And actually at the end of the week, we're closing on another 700 units. It'll be close to 4,500 units that I have as a general partner. And those are deals that I'm very active in, that I manage, as opposed to the ones that I've just invested in.
That's incredible, Matt. Congratulations.
Thanks.
And obviously, you're currently a syndicator. And for people at home who are new to real estate, they might
Yeah.
not know what syndication means or what a syndicator means. Can you please describe that to the layman out there?
Yeah, I was involved in real estate for I think like 15 years before I've ever even heard of syndication and found out what it was. And that was a big light bulb moment for me. And I got really involved with it. Syndication is when a group of people pool their resources together to go after an investment that they otherwise wouldn't be able to do on their own. So in my case, that is specifically multifamily apartment buildings or apartment complexes, where we'll buy a 200, 300, 400 unit apartment complex, or in the case of the 700 units we're about to close on, that's across 3 different apartment complexes. But syndication could be done many other things. People buy strip malls, they buy self-storage facilities, and actually Broadway shows. A lot of Broadway shows are set up by syndications, and that's how they capitalize Broadway shows.
That's right. And you've got a background in Broadway shows, right? Is that how you got started? Kind of, you want to fill us in on that?
Well, I do. That's not how I got started in syndication, really, although my first passive investment was in a Broadway show, and it was a syndication. I just didn't know it was a syndication at the time. Like, I didn't know it was called that.
Yeah.
But yeah, I have a background in the theater. My wife works in the theater full time. That is her job. And she's on the business side of Broadway. And her and I have joined forces a few times on some shows. Actually, those who are watching on video can see I've got a couple Tony Awards back there for
Nice.
a couple of shows that we co-produced. We have some shows that we're working on right now that are in development. And we're big fans of the arts and supporters of the theater.
I think that's really interesting too. As I reflect on your situation here, you've transitioned from being involved in theater to being more active in real estate. Do you feel like you're kind of breaking the traditional pattern? A lot of people, they feel like they're myopic, they're focused on just one career track, but you've demonstrated that you can pursue the arts and go into real estate in a big way too, right?
I've made a couple of major pivots in my life as pertains to my career. I grew up in Orlando, Florida, moved to New York to pursue a career in theater. I went to a musical theater conservatory, graduated from there, was off on the road, was a professional actor for about 5 years.
Yeah.
And then the dot-com heydays were upon us, right? We're talking about the mid to late 90s here. I started doing that in between acting gigs. Instead of waiting tables, I used to be a waiter at the Hard Rock Cafe. So it was a little easier and a little more lucrative for me to do the website development. And then the next thing I knew, I sort of had my own boutique agency doing website development. And then 2001 came along and the dot-com bubble burst and all of my clients went out of business and my business imploded. And then my landlord called and told me I had 90 days to get out of the apartment I was living in.
Wow.
So I got a job in-house at one of my clients Showtime, the cable television channel, but instead of renting a new apartment, I bought one. I then sold it about 2.5 years later, and I saw my initial investment more than quadruple in value. And I
That's
was like,
crazy.
oh, how do I do real estate again? And so
Yeah.
then for the next 10 years or so, I did real estate as a hobby while doing the digital marketing. And then about 8 years ago, I transitioned from doing the real estate as a hobby into doing the real estate full time. So that's kind of he's an actor, digital marketing, and now real estate.
And as you reflect on this too, a lot of people out there, they're probably wondering, should they go into real estate full time? Should they jump into syndication? Or should they pursue a similar path to you, starting as a hobby and slowly segueing into it? What do you recommend?
I think that if you really want to do real estate, you should just jump in like whole hog. Honestly,
Yeah.
I had I known about syndication a long time ago and gotten involved in that, I'd be in a very different place right now. I think that, a lot of people think, oh, I have to do single family first. You don't. I went from, I need to do single family, then I'll do 4 units, then I'll do 10 units, then I'll do 20, and then 40. I went from a duplex to 132 unit, $10 million apartment complex. That was the jump that I made. Now, I didn't do it alone. I joined a group. I got coaching. I got mentorship. I had a co-pilot doing it with me who had done it many times before. I spent, a couple years assembling a team that would allow me to do that. So it's not like I just woke up one day and was like, oh, I'm just going to go buy 132 unit property. I got myself educated. But that is how you can do it. That is how you can succeed. And I don't think you need to start smaller. You got to do what's comfortable for you. But I think getting out of your comfort zone actually pushes you and propels you to go further in life.
Absolutely, 100%. So I'm curious too, Matt, as far as the strategy goes, I think a lot of people debate, should they own 100% of 1 unit or 4 units and go at this in a smaller way with full ownership versus syndication? For you, what was part of that thought process? How do you decide syndication versus just owning properties on your own outright?
Right. Because with syndication, there's a number of investors together. So you have fractional ownership. You might own 1/10 of that apartment complex, or 1/100th or 1/1000th, just depending on how much capital you've invested into the deal as a proportion to the total deal amount. For me, I do own some things completely, 100%. That's good, but then all the onus is on me, all the way around, and all the profits are mine too, which is cool. The thing that I like, and the reason why I've chosen to invest, in over 7,000 apartment complexes across the United States, well, not 7,000 complexes, but 7,000 units across multiple complexes throughout the United States that are run by people other than me, is to have that diversity. Geographic diversity. I most of my investments are in the Sun Belt. And I'm talking as a general partner. I deal a lot with Texas, and what we call the Texas Triangle, which is from Dallas, Fort Worth down to San Antonio, and then over to Houston. That kind of makes a triangle. That's where I tend to do most of my investing as a general partner, though I've done stuff in Kansas, and I have a really interesting project that I'm doing right now in Canada. But I can't. Yeah, we can talk about
international, Matt.
Yeah, I'm going international. I have an amazing partner who is in Ottawa. Actually, there's 2 partners on that deal along with me. One of them is based in Ottawa. The other one is also based in Ottawa, but he's also the general contractor, and he's been doing deals there for the past, I think, 40 years. So he knows he knows that market very well. But getting back to the geographic diversity, I really like. So I invest in deals in Atlanta, in all over Florida, in Colorado, but I can't be an expert in all of those markets. But if I can find other people who are experts in those markets, I can invest with them. That's one of the reasons why I like this Canada deal, and why I think a lot of my investors like it, because they don't have anything in Canada. And it's an option to diversify outside of the US with a real estate market that's not correlated with the US real estate market, right?
Sure.
but it's our good neighbor up north, right? They speak English, so you can
True.
understand the contracts. They have a stable form of government. So there's a lot of reasons why, if you're investing internationally, that you need to worry about, that are kind of alleviated by investing in a great country like Canada.
And then going back to your investment in the Texas Triangle that you were referring to a moment ago, how come you've chosen that Sunbelt region? What was part of that thought process, and why do you do that?
Well, I like to invest where there's growth. Where there's going to be growth, then there is demand for housing. And so having from a sort of macro look at markets, if you can move into markets where there's growth, that can help your situation quite well in real estate. And so when we look at what's going on look at some of the markets that are the fastest growing in the US, DFW, the Dallas Fort Worth market, comes up. Houston still comes up. I mean, these are booming metropolises that are working very hard to bring in new employers, and people go where the jobs are. Also, the cost of living is a lot less. I mean, you look at a lot of companies have left. Even New York. I live in New York. I love New York. I'm in Brooklyn. I love New York City, but there's a lot of companies. Look at Alliance Bernstein, a big company, big financial company that was in that was in New York, has left, and they moved. They actually went to Nashville, but they moved everything there. But you have a lot of companies going to Texas, and a lot of California companies are going to Texas. HP moved their headquarters there. Toyota's moved their headquarters there. I mean, just there's so many different companies moving there. There's jobs there, and you can live there for a lot less. I mean, I could sell my place in New York and buy a castle in Texas. I mean, for what I mean, like
Yeah, you
for
can.
$100,000 is very hard to buy something in the tri-state area of New York, but in Texas you can buy something for $100,000, a nice place, and then if you have more than that, you can get an even nicer place, and cost of living is just a lot less. So employers can attract great talent and not necessarily have to pay as much, but great talent who wants to live somewhere where they can have a nice lifestyle may enjoy Texas.
And then, Matt, a moment ago, you were talking about too having the right experts locally for sourcing deals. When you're finding deals, do you do it through brokers? Do you do it off market? Are you sending out letters? How do you find the best deals? What's been your experience?
Yeah, I've never sent out letters. I did a letter campaign once when we were in Boston because I was looking for something locally, and that didn't turn anything up. And I think it was because to be really successful with those, you have to have consistency and just be doing it month after month after month after month.
Yeah.
And I wasn't really that interested or committed, and ended up moving back to New York anyhow. So it kind of killed that interest. But I find all of my deals through relationships that I have with brokers, with property managers, and with owners. But it's very seldom that you're going to find an owner, unless you're very good friends with them, who's going to that owns a 200 unit property, that's going to get a letter in the mail and say, oh, I'm going to sell my apartment to these people. They're getting approached very often by brokers, and those brokers in those markets have large databases of investors, and I'm one of them usually, right? But they have investors from all over the US and sometimes all over the globe. And there may be people looking to place capital. There may be a 1031 exchange. There may be reasons why someone could bid higher than me. So I think savvy property owners, I mean, every time I sell, we're going through a broker. Like, we're not going to try to sell it on our own, because they have more contacts and connections and can fetch us the highest dollar, which we want to sell our property for the highest dollar so that we can give the best returns to our investors and ourselves. We invest in our deals ourselves. So we have a vested interest in having a successful high sale.
Can you give us a sense too of the typical deal structure? What do you look at for the down payment, the equity, and then do you do cash at refi versus selling it? How do you make that decision?
Really good questions. I know that you know this, Matt, because you've commented on it many times, but I have a YouTube channel where I talk about things like that. And one of the new ones that's coming out very soon is deciding whether to hold or to sell your property. You might want to check that one out in a couple of weeks, Matt. But
Excellent. We'll teaser
I the determining all these things are really good questions. So when it comes to the capital stack, right? How do we put the deal together when we're looking at the money, right? We usually have a certain amount that is debt, right? And that usually comes in a traditional form as a mortgage from a big lender, right? And that first mortgage will usually be somewhere between 60 to 80% of the purchase price. So a few years ago, we could get, like clockwork, 75%, and sometimes up to 80% of the value would be that we would have debt come in for that. Now, with the markets the way that they are at the moment that we're recording this, getting 75 to 80% is not really possible. It's usually more like somewhere between 60 to 65. Maybe you can get to 70. Depends on the deal. Depends on the market that the deal's in, depends on the underwriting for the deal, depends on the lender. It depends on how the lender feels about the sponsorship group. So when you have a syndication, you have the sponsorship group or the general partners or the syndicators. Those are the people who are running the deal. And then you have those limited partners who are the investors. So a bank's going to want to look at who are those people who are running the deal. The people who are running the deal also are usually signing on the loan, some sort of guarantee. So all those different things are factors that are taken into account, but you're looking at usually 60 to 80% of the purchase price being the debt. Then the rest comes in the form of equity. Now, there are some other things. There's a thing called mezzanine. There are things called preferred equity. We can get into minutia of many different ways to create what they call your capital stack. But essentially, there's debt, which is usually like that first mortgage, and then equity, which, a lot of times, especially in my earlier deals, I just raised just regular equity. That's usually what I do. Sometimes we'll bring in another piece, but it's usually just all equity.
And so interest rates right now, I think we're starting to hear about mortgages being in the 7s or 8% range for regular single family homes.
Yeah.
Do you feel like this may be a point where you're going to back off and hold back on the market? Or do you feel like this is the kind of opportunity where people are freaking out and panic selling? How do you react to this interest rate environment with rates skyrocketing so fast, so quickly?
Well, there's two things. The first is, there's two sayings that I like that you've probably heard before, but, Warren Buffett has a quote of, be greedy when others are fearful. And then there's a Baron Rothschild thing about blood on the streets, right? But I don't know that there's blood on the streets quite yet, but, there is a concern, and rightfully so, by many people. But now is probably a really good time to buy real estate. It's really hard to time the market. It's really more about your time in the market versus timing the market. We're doing a deal right now that we're about to close on, the 700 unit property that I mentioned before. That deal, we're getting a 3.8% fixed interest rate.
Come on.
Yeah.
What?
So, on commercial loans, we're not quite seeing 8% most of the time. It depends if you're doing bridge debt, possibly, but on, Fannie or Freddie debt, I think, we're still in the upper sixes, just depending, like I said, on the deal, the market, the team. But to get 3.8% interest rate, it's really good. We are,
yeah, it's amazing, Matt. That's amazing.
It's great. So we are assuming debt from a seller who has a very large portfolio, has had these for a little while, wants to sell them off. He's going to make a nice profit, and I think use that to sort of recalibrate his own portfolio. But we're able to get three really choice assets at 3.8% fixed interest rate for the next 7 years. And 7 years should give us more than enough time to execute our business plan and exit the deals.
That sounds like a sweet deal. The financing sounds amazing. So kudos on that.
Yeah. So, when you have a market where things are a little haywire, sometimes you can be creative and assume debt or, other things of that nature.
As you reflect on your deals, is this a common technique to use? Like, what percentage of deals do you assume debt versus obtaining new financing through Fannie or Freddie?
I'm just thinking about it to make sure. I've never assumed debt before.
Wow, this is exciting. The best time to do it.
I've sold many deals where we've sold where the buyers come in and assumed our debt. But I've never bought something on an assumption. All the deals that I've done in the past, it's just made sense for us to get new debt on there's so many different factors that go into all these things. You got to kind of put them all together and see what makes the most sense.
And I'm curious too, with all the deals you've done so many deals, Matt. Do you feel like there's like one key observation, one key lesson that you learn from these deals? You're like, oh, I got to watch out for the roofs, or I got to watch out for the parking. Like, what would be the biggest lesson you've learned through all these deals?
Oh, I don't know the biggest one, Matt.
There's no consistent one.
It's a really difficult question.
Yeah.
I mean, I think the most important thing is to get yourself educated, right?
Right.
And so as I learn things, I'm still getting educated, right? I'm getting educated through the school of experience at this point. Always something new comes up that's interesting. So I coach people on real estate, and I have a student, and I was just out visiting him and looking at a deal that he has. And there's like this crazy thing with the utilities that I've never come across before that he's run into, which is a bit of a snag in the deal. Hopefully he'll get through it, trying to help him out. But yeah, I mean, it's just like it's a thing. I think it's a unique thing for that specific market, right? And I've never owned property in that market, so I didn't know about it. This person didn't know about it. And we
part of the fun, right? Part of the fun.
It's also a new regulation that just came out. So yeah, there's just a whole bunch of stuff that's part of the risk that's involved. And that's why it's good to come in as a limited partner on a lot of these deals, because they've already, by the time they're bringing you in as a limited partner, hopefully, if they're doing their job right as a syndicator, they've already gone through the due diligence. They've already got everything locked and loaded. And they're just raising the capital. Sort of, that's kind of like the last part of it all. And they've greatly de-risked the deal. As a sponsor, you're coming in, you're putting in non-refundable money. You've got all these pursuit costs. There's a lot of risk that you're taking on, but you do get a very nice share of equity for that. So you get compensated for it, assuming the deal goes through, right? There's many syndicators. I had a deal that I was looking at that we pulled out. We got a little further into the deal and we said, you know what, this doesn't make sense. We're not going to pursue this. And I had sunk costs into that deal, but that's what you do. You have to, that's part of the business.
Matt, a minute ago, you mentioned teaching people. I know you got to go in a minute here. Are you still taking students? And if so, where can they find you?
The best thing to do is to go to picheny.com. That's my website, PICHENY.com. You can sign up for my free newsletter that has tons of free tips on there. There's free articles on the website. There's a ton of free stuff, but also you can contact me through there if you want to talk about real estate coaching. I am taking students.
And if we find any beautiful pocket listings here, what kind of pocket deals do you want? What would be the criteria for those?
I like deals that have a value add opportunity. Usually we need things to be, as close to 100 units as possible for it to sort of make sense, but that's market specific. I say the first deal I invested in as a limited partner was 77 units in Albuquerque, New Mexico.
Yeah.
And the purchase price of that property, the whole complex of 77 units, was less than my duplex in Brooklyn.
Come on.
So it can depend on the class of the property and things like that. But usually we need the deals to be like close to 100 units or more for it to make sense.
Awesome. We'll try to send some your way. Matt, thank you so much for your time today, Matt. Really appreciate it. Great to see you, and good luck with your huge deal this week.
Thank you. And it was an honor to be on your podcast. Thank you so much.
Thanks, man. Take care. Cheers.